Hey, what's up YouTube? Thank you for tuning in to howtoplaystock.com. My name's Casey. Today is April 14th, 2017. It's Friday. Hope you guys are having a good day. And today's video, I just wanted to shoot a topic about shorting the markets, okay? Now, if you follow my channel or you've been tuning in, I've been talking about some of the uncertainties in the market that are starting to show their ugly face. I'm referring to things like what have happened just in the past week with like Donald Trump, launching the cruise missiles into Syria, the situation with North Korea, those sort of things. Now, these events can affect the markets, short term and long term. Not to mention we have problems within our own monetary policy through the Federal Reserve right now, and that's taken an effect on certain assets in the market as well. So long term, if you've been following me, I've been saying that the markets are going to be turning over and we'll be going into a recession or a possible depression over the next 4 or 5 years. Now, that's just my opinion, and that's based on all the research that I've done, all the things that are taking place on a geopolitical scale. So, you don't necessarily have to agree with me on that, but one thing I would highly suggest is that you protect your wealth regardless of what happens if the markets go up or down. One way you can do that is to, if you're wanting to play the stock market, one way to do that is to get into ETFs that short the market. And that's what I'm going to be covering today. So stick around, keep watching, and I'll see you guys in the next portion of this video. Okay, so in today's video, we're going to be covering shorting the markets with paper assets. Now, before I get started, I want to let you know that the paper assets are, they're specifically tied into broker accounts. All right, so you're buying a certificate basically, or a stock. Now, there's a substantial amount of risk that you take because you lose control over a lot of different aspects when it comes to investing in a certificate or a stock. Especially when you compare that to like a hard asset, something that you can touch and feel, gold, silver, real estate, stuff like that. So when you're investing in paper assets, you have to remember that the risk goes up because you lose control over the fact that, it's outside your control what happens while your money is tied up in a bank or a brokerage account or something like that. Now, to give you an example of the risk that I'm talking about, let's just say there was hypothetically speaking, let's just say that there was a credit freeze and liquidity in the markets froze up. Now, what would happen, and this isn't 100% certain, okay, because every broker is different, every company is different, but what might possibly happen in a hypothetical situation with a liquidity freeze is that banks would stop trusting each other like we saw back in 2008. Okay? If that happens, if they went ahead and froze up credit so that you couldn't make transactions between banks, there is a possibility that that could happen with brokers too, broker firms. So like if you have like Capital One or TD Ameritrade or somebody like that, if you were invested in stocks at the time you wanted to get out, and let's say there was a freeze on credit, chances are you may not be able to sell your stocks because it is a transaction that's being taken place in the form of credit or digital ones and zeros. Okay, so your risk goes up there, and if you can't get your money out because you can't sell your stock because no one's willing to do business with that brokerage firm, then you're stuck. So I want you to keep that in mind, because if you're shorting ETFs, these ETFs are specifically designed to be inverse to what the markets do. So, for example, if the S&P 500 ends up turning over and going down in a correction or a crash, maybe something like a flash crash like what we saw in 2011, if that were to happen and you're invested in an inverse ETF, it's going to do the exact opposite of what that market's doing. So it'll go up in value. Now, if you're playing paper stocks or paper assets and you're invested in these when the markets start going down, you can profit tremendously off this, all right? I know this because I did this for almost a full year back in 2015. All right, I lost my job in IT, decided to put that on the back burner, and I got invested in ETFs that were inverse to the markets. I started doing some day trading, and I figured out pretty quick how these things work. So I want to shoot a video on that, and I'm going to give you a list of the top 5 inverse ETFs that you can use on the markets. Now these stocks have been picked not by me, but by other people on Google. And I'm going to take you in on a separate video here, and I'm going to show you those stocks and what they do. But before we do that, I just want to cover some of the aspects and components around these ETFs and how they kind of work, so you can better understand, what they do in the markets, okay, and how you can use them. So basically, like I was saying, you can profit when broad markets crash, and you do this by getting into these inverse ETFs. This revolves around timing, okay? Now that's another portion of where your risk goes up, because if you're timing markets and you've watched my channel, you know that timing the markets is damn near impossible to do over longer periods of time. Okay, now short term, yes, you can predict the markets, you can kind of get a better idea of what they're going to do, but you're still speculating, you're still guessing. So it's not necessarily 100% certain that you're going to be right every time. So your risk goes up because you're timing the markets. So you need to understand that portion too. All right, so your risk is really high with these, and before you get involved with them, you need to do your research on them. So when you're shorting the markets, just remember it's more of a short-term play. All right, I know just based off of my experience doing the day trading for almost a full year on these, the ETFs that I used, when I did mine short-term, I was in and out. So I was in for maybe 3 or 4 days, at a time, and then I'd pull out. You can play them longer than that if you want to, but again, the longer you play these, the higher your risk is for losing money. And that's the last thing you want to do, is lose your money. You want to make money when these markets go down. So timing is very crucial. You want to play them short term and get in and out. All right. Now, when I was talking about understanding the stocks and how they work, you can, for instance, like there's some ETFs out there that are inverse to markets that are created by certain companies that are hedge funds, basically. So like iShares, for instance, is one of them. If you go to their website, you can actually look up what they call a prospectus. Now these prospectus, what it is basically is it explains what the ETF does, how it works. It'll even break down some of the taxes on these and how they're taxed as well. That's another important part to understanding what ETFs you're playing, because there's, I believe, capital gains on these if it's not long term. So in other words, if you're playing an ETF inverse and you make profits during a market crash, if you're not invested in that ETF, say for more than a year, and you make a short-term trade, okay, maybe it's a couple days, maybe a month or two, and you get out and you make profits on it, you're going to be taxed out of short-term capital gains. All right, now that percentage of what you're taxed varies depending on your tax bracket that you're in. In other words, how much money you're making for the entire year. And the percentage of money that you're taxed is based off of that money that you make for an entire year. Now, I think for most part, for 2017, the short-term capital gains tax on average is roughly around 25%. Okay, so just keep that in mind. Again, you can go look at the prospectus on these and find out what the tax is on that. What we're looking for here, though, is market weakness. All right, and the reason why I say that is because these ETFs that I'm going to show you are specifically designed to be inverse to a market crash. So when the markets go down and they start correcting, these ETFs are designed to go up. All right, so you're looking for market weakness. And lastly here, you want to use ETFs that are like I'm saying here, they're inverse, so they're going to do the exact opposite. But we're looking for ETFs that are not leveraged, because when you go in and I show you this next portion of the video, I say at the very beginning that the stocks that we're looking at are excluding ETFs that are not leveraged. They're still inverse, but they're not leveraged. So you want to stay away from leveraged inverse, because the leveraged inverse, the more leverage you have, yes, the higher your returns are going to be, the more profits you can make, but the higher your risk is too. So if you end up having a trade go against you, that leverage can make you lose a lot of money. And I'm speaking from experience here. I was involved with a couple inverse ETFs back last year, or not last year, but in 2015, back in August, when China had their markets, they devalued their currency and their markets crashed by about 50%. Okay, I was involved with an inverse ETF, and the trade went against me, and I ended up losing quite a bit of money on that trade. Luckily, I was smart and I knew what I was doing, so I got out in time, so I wasn't losing too much money. I could continue playing the game, but that was just a situation that I experienced where that leverage, because I was using a leveraged ETF, that leverage played against me. So you want to get away from that. And the reason why I'm saying this again is to reduce your risk, but at the same time, you can still make profits during a down market or a crash. All right, it's totally up to you what you want to do. If you're okay with, if your tolerance for high risk assets is pretty good, and you know what you're doing, go ahead and play leveraged ETFs. That's completely up to you. But just know, yes, you can make a lot of money, but if that trade goes against you, you're going to lose a lot of money too. And we want to reduce that risk. So the ETFs we're going to be looking at here are excluding the high leveraged inverse ETFs. And that's specifically so that if you got into a stock or one of these ETFs and it went against you, the amount of money you're going to lose is less. So keep watching. All right, you do not want to miss the next portion of what I'm going to show you here, because we're going to actually take a look at some of these ETFs. All right, so continue watching, and I'll see you in the next portion of this video.
So we're here looking at an article that I found. It's called the 5 Best ETFs to Short the Market. Now this article is excluding ETFs that are leveraged. So in other words, stocks that might be inverse. Those greatly increase investors' risk. And I've actually used inverse ETFs before, and that is nothing short from the truth. I've made a lot of good money with those because you're leveraged, so your returns are greater, but your losses are greater as well. So the ETFs that they're covering in this article are excluding the leveraged ETFs, and the reason why, again, is to reduce your risk so that you're not losing as much money if a trade goes against you. Shorting individual stocks. These are just a couple notes that I took. Shorting individual stocks can be riskier than buying ETFs that short the market. Okay, so the ETFs they're giving us in this article are more broad-based. They're based on indexes instead of actual individual stocks. And what we're looking for here, since we're shorting the market, is we're looking for market weakness. Okay. Now the ETFs that they give you in this article, we'll just cover them real quick. There's 5 of them. There's the ProShares Trust, and it's shorting the S&P 500. So if you ever see the S&P 500 index, which measures large cap U.S. stocks market performance, if you ever see this thing start taking a nosedive, this is a stock that you can get into that will make you money while the S&P 500 index loses value, so you can profit on that. This fund takes short positions in the index, making it a broad-based method for shorting the U.S. stock market as a whole. Now, I'm not going to get into the details that I'm highlighting here, in regards to net assets, average volume, inception date, all that. I'll leave a link for this article in the description below so you can go back and read through this. But the second ETF I have here is CHAD, CHAD. It's the CSI 300 China A-share bear 1x ETF. If you expect China's economy and market to stumble, you can use this ETF to short the CSI 300 index. The fund shorts the largest stocks in the Chinese market. So if you ever see China start having problems with their largest stock markets, this is another one to look at. The nice thing about these, some of these are US based. There's more than this out there. There's ones for Europe and some of the different countries out there, so you have way more options. But again, these are just five of the best ones when I did a search on Google for 5 best ETFs to short the market. This is what I found. So just keep in mind there's other options out there for you as well. The third one here is SAGG, the Total Bond Market Bear 1x ETF. The Fed has indicated it will raise interest rates regularly going forward. Higher interest rates tend to hurt bond prices. So, like I've said in some of my other videos, when the Fed raises interest rates, the value of the bonds will go down. So you can short the Barclays Capital U.S. Aggregate Bond Index with ETF SAG, SAGG. You have ticker symbol ERYY. This is ETF number 4, the Daily Energy Bear 1x ETF. If OPEC fails to rescue the oil industry by boosting oil prices, energy could be in for a tumble. So ERYY, it shorts stocks on the Energy Select Sector Index. Okay, so whenever news comes out about OPEC, and they fail to rescue the oil industry by boosting oil prices, energy, get ready, it could roll over. And if it does, you can look at this ETF here, the ERYY. And last but not least, we've got the Gold Miners Bear 1x ETF, ticker symbol MELT, MELT. So gold can suffer when the Fed raises interest rates because the dollar loses value. Gold is priced in US dollars. If the dollar weakens, it will take more dollars to buy gold. So you can short the gold market with MELT. And they say, note that MELT shorts emerging markets as well as the developed markets. So bottom line, shorting individual stocks can be riskier than buying ETFs that short the market. So instead of looking for company weakness, you got to get into the habit of looking for market weakness, and you do that by looking at indexes, which measure broad markets. So this kind of plays along the same lines as what I've been teaching and emphasizing on my channel for quite some time now, and that's reducing your risk and having more protection by indexing and looking at indexes. Okay, because as they say here, you will have the protection of shorting several stocks instead of just one. And they basically back up kind of what I've been saying in some of my other videos about indexing, is this spreads your risk. Okay, so you can do the same thing when you're shorting the market. You can spread your risk, you can diversify. So hopefully this article was beneficial. If you like the information that you got here, go ahead and subscribe to the channel, hit that like button, share it with others. These are today's investors' investing tips. You're tuning in to howtoplaystock.com. And remember, guys, income is the outcome.